Hi, everyone. This is Alex coming to you remotely for the On the House podcast today here with Rochester Homes. And the topic of conversation for today is these incredibly low interest rates that, of course, everyone who's looking at building a new home is talking about. And frankly, everyone in the country, when they're not focused on the global pandemic, is talking about. So, our guest today is Tom Coronato with Citizens Bank. The reason that we tapped Tom today to discuss this with you is because Tom has a really unique perspective as a nationwide lender. He's able to do business across the U.S. And so that should hopefully bring in some really unique perspective as to what's going on with this rate environment across the country. So, Tom, I'll give you a quick chance just to say hey and introduce yourself.
Sure. Well, thanks for letting me get here and chat with you. So I'm with Citizens Bank. It is a national company, one of the top 20 lenders. We're based primarily on the East Coast, but again, my world, as you know, is a little bit different because I'm in the new construction world, lending all over the country. So in the last probably 20 years, I've been doing new construction financing. But that's sort of more of the expert part of things. The regular day-to-day stuff of the purchasing, refinancing, second home investor, that's all residential lending, and that's in my wheelhouse. So appreciate you having me.
Yeah, it's great to talk to you again. Tom and I got to know each other through the Building Systems Council. So a quick plug for the NAHB Building Systems Council. That's what helped form this relationship for us. And if you're not a part of that already, you're one of our builders, please join that. So Tom, today to start off, just a quick, maybe from your perspective, you were saying historically, I know you haven't done the research to find out exactly what this rate environment looks like versus history. But as far as in our lifetime concerned, the current rate environment's as low as it's ever been, as low as we could ever hope for it to be, right?
Yeah, I mean, we are in modern day lows for sure, historic lows. And again, when I joined the industry, say in 98, I actually got in the industry because rates were at a low then of 7%. And then everyone that was in it prior to me said anything under 10 was easy. So in the 80s, I understand we were in the teens. And then, going into the late 90s, early 2000, where we dropped down, and like I said, to 7, 6, into the high sixes, that was considered low. And they were right, because a year or so later, we were back into the eights. And then I guess for all that next decade, we just continued to go down. And every time we hit 6, it was never going to be lower. And then 5, it was never going to be lower. And then 4, it was never going to be lower. And we bounce up and down, as you know, because they're cyclical. But when we were quoting, I don't know, several years back anyway, like 3.5 or 3.25, we felt that was low. And we would never see it lower again. Yet here we are today with, 30-year money in the high 2s, low 3s, and 15-year money in the mid 2s. It's historically low for sure.
Yeah. So as we came out of the Great Recession, we hit that kind of like mid 3 market. And then really we went back up for a little while. And I'd say for the past, I don't know, at least few years, we've hovered in that low 4 environment. So from your perspective, I mean, versus that low 4 environment, what does this mid 2 to high 2, 15 to 30 year respectively environment look like from a customer's perspective? How much more house can I buy? Do you guys have benchmarking systems to look at that? Do you just run numbers on that? How do you guys think about that?
Well, I mean, it comes down to tolerance of pain, say it, from the borrower's perspective. Tolerance of pain meaning how much do you want to pay monthly, right?
Sure.
So, if you were just jumping, and maybe this answers the question, I hope, but if you were at a $200,000 loan, and that can be, with minimum down or putting a lot down, as long as the loan ends up at, say, 200, on a current rate today of 3, the borrower payment might be about $840, $850. But if we see where rates were, say, even just at the beginning of the year in the 4s, so you go from 3 to 4, you're going to have about $100 to $110 jump in payment. So, not that that's a whole ton of money, but it's going to, if you did like a dollar per dollar sort of comparison of that, the borrower, for one, the difference in rate, just doing nothing, the increased rate's going to cost them, $1,300 a year, $13,000 over 10 years, $39,000 over 30 years. But, that $100 payment or $100 plus is $25,000 less buying power just with an increase in rate. So again, they either have to compromise with a higher payment, or if they can't compromise on a higher payment, then a lower house or maybe less amenities.
Right.
If you combine that and jump into the $400,000 range, you're going to take a 3% $1,700 payment, jump it up to $1,900 plus. It's going to be $200 plus a month. And again, in today's world, over 30 years, that's 70, 80 grand that the borrower pays extra just with the rate jump. And then, again, $200, 50 grand buying power less, just with a rate jump. So,
wow,
that's off the
really
top of my head.
That's, yeah, that's incredible if it is. So yeah, that's the exact answer to the question I was looking for. It's just, everyone hears about rate increases, decreases, but until you can put a dollar figure per month and annually, like you just did, it's hard for a lot of people to understand why it's really worth pulling the trigger when you're, a percent drop in your mortgage rate. You can buy, like you said, $25,000 to $50,000 more house, or incur less payment, obviously. So from your perspective, and maybe this rolls down from Citizens Bank and what they're telling you guys on your forecasting calls, how long can we expect this? And I realize everybody's answer right now is based on a global pandemic, and are we seeing a resurgence? Are we seeing a second wave, whatever you want to call it? But do you guys have any kind of either bank-wide or even personal intuition about how long we're going to see rates this low?
I don't know that Citizens has a formal statement on the subject. I think that anything that we would have would be out there publicly. Really, my personal opinion from experience and just seeing what we're seeing, I think it's not any greater than anybody else's perspective of, the COVID-19 thing definitely has changed the industry dramatically in a very quick reactionary time. You had a big announcement in March of the pandemic, say was it February or March, where we shut down, and then immediately following that there were guideline changes from Fannie, Freddie. We're a portfolio lender, so even with our own monies there was a tightening of the belt in anticipation of what I feel was similar to where we saw the reactions to 2008 and that time frame. I think again, there's debate on this, right? I mean, do we have a V-shaped recovery or U-shaped recovery? This is this is a more of a forced recession. It wasn't one that was as say dramatic as the last recession. But I mean, there's two big things coming up. If we have that second wave, we will find out. If we don't, or it just sort of continues, you also have an election coming up. No matter which way that goes, you're going to have investors react and the market react in one way or the other. I mean, it's just it's similar to 2016, where there was a sort of a pause in the industry, and we didn't see until the results of the election that there was a change. So I think it's just, personally, I feel that we'll probably be flat, similar rates. I mean, how much lower can they go is always the question. It'd be nice if it just goes to zero, then everyone just gets a mortgage and then the bank just pays their mortgage for them. So
perfect. I mean, is there talk about any way for it to go lower? I mean, even if a second wave hit and shut down the economy again totally, is there a lower? I mean, I just, in my mind, I guess that's maybe naive of me, but I just, from what I know of mortgage rates over my lifetime in the industry, I just didn't imagine there was a lower conversation.
We say that every time we hit a new benchmark of low. Is there lower? I believe banks are buying at extremely low amounts, close to 0%. Again, can it go lower? I need a better economics degree, I would say. But if you look at like a 10-year ARM today or a 7-year ARM, not that people are looking at adjustable rates, but when we're quoting adjustable rates at like 2.5, can it go lower? It's almost impossible because they're based on a margin program. So like if the index is at 0, the lowest that can ever go is say 2.25 or 2.5. So there's got to be a floor. But on the fixed rate, if we do go lower, I mean, I think we're going to have bigger problems somewhere along the line. But will it tick down to where you get a smidge better here and there? Yeah, it may. But if you're holding on to that, I think the borrower, anyone borrowing money, has to look at it in the long term. If they're holding for lower rates, they're going to get caught up in the problem of what happens if you have rising cost to build. And then they've got the lower rate, but the cost to build has gone up because the products have cost more. And then therefore, you've negated the chance that you've waited. And all of a sudden, now you're stuck in a position of you still have the higher payment anyway.
Yeah. Yeah. And we are seeing that. I mean, if there is anyone who's holding on for a lower rate or just waiting for no change, I mean, we're seeing a drastic change in the material supply environment that came out of a result of the 45-day shutdowns in a lot of states. I mean, that's still just now hitting the market. And then, of course, we're seeing an increased demand because of the low rates and, a lack of ability to up capacity for a lot of material suppliers, either pandemic related or shutdown related, or just back to the labor market concerns we were having before this whole thing. There's just not a whole lot of people left to jump into the workforce who weren't already in it. So we're seeing prices hike drastically. So yeah, if there is anybody waiting, my personal take on that would be don't wait too long because prices are only going to go up. So you've talked a lot about, and to kind of recap, it sounds like your personal opinion is there's a lot going on in this rate environment outside of just, historical, looking at yield indexes. We're talking about a pandemic, obviously, and an election year. There's a lot going on. So maybe too soon to tell, what's going to happen this fall. But what else is different about these rates to you? I mean, are you more or less telling people, hey, you should look at a 15-year versus a 30-year? Are they too close together to the point where you're like, yeah, doesn't really matter? Or, is there a difference there?
I mean, 15-year fix to me, it's a matter of opinion. If a person wants to take that, you can always prepay. I think if you take the 15-year, you sometimes get into a situation where there's no dry powder. What happens if something again happens? You can argue it for any way that you want. I'm just personally not a big 15-year person. I'm more of the take the lower payment and enjoy the fact that you can prepay it when you're comfortable. I have had many clients over the years start in a 15 and call me 2 years later to refinance to a 30 because one of the two are no longer working or have retired, or there's unforeseen reduction in income of one way or the other. And usually when that dramatic event happens, like there's a big change, they don't qualify in that 15 anymore. So sometimes they don't even qualify in a 30. And if it's at crisis mode, then, it's more of crisis where they have a better chance of paying a 30 than a 15. But the 15 rates are, that mid 2 range. Like, again, it's dramatically low. If you side by side a 30 and a 15, taking out the fact that there'll be some differential in rate, if you were to pay a 15-year payment on a 30-year note versus a 15-year payment where you have to pay it, you can basically pay them off at the exact same time by prepaying a 30 at the payment of the 15 without having to necessarily put you under the stress of knowing you have the larger payment. The 15, I think, is a personal choice that someone would make. And then, you would sort of have a conversation and sort of test the grounds of, again, a person's tolerance of paying for the mortgage payment and what they ultimately desire. Some people would prefer to be debt-free. Others would prefer to take, a large loan at a very low rate and have their money earn money elsewhere. So there's that delicate, balance for those folks.
So it sounds like, especially in this super low rate environment where the gap between the 15 and 30 is only, 0.375, you'd say that's the cost of basically insurance against people losing their jobs. The worst case scenario, the 30 years seems like a safer play. Historically, let's say when rates were, like you said, you started at 7 or, they were at 4 for the last few years, that gap between the 15 and 30 years is typically a little bit bigger, isn't it? Or are we just following kind of the same gap line at lower rates?
I believe it's about the same differential. Yeah. I mean, the bigger thing is on that $200,000 example before, where if you're at closer to 3%, you're $840 a month. I was just scratching some numbers here. And the 15, I believe, runs up to about 13 plus. So it's about a $500 difference. So it's significant. It's basically taken, 1.5 times the payment versus one. So again, it goes down to, a first-time buyer may not be ready for that jump in payment because there's a lot of other things that go into the home. So that's where, again, is it a refinance where the person's been in the home, been established, and basically prepaying anyway? Now they might choose to send it in faster and pay it off faster versus, say, the new home buyer where maybe that $500 is a car, maybe it's upgrading the house, maybe it's things that you need in the house for a while, and until at such point they're comfortable with all their stuff, and then at that point they start prepaying. So.
Sure.
You don't want them playing the game of, well, I'm getting a 0% financing from the furniture company. Well, I mean, it's fine, but that's not really, you're still, in debt. So.
Sure. No, that makes a lot of sense. So the other thing I had a question about, in this rate environment that's different from maybe a year ago, everybody's working from home, right? So are you seeing things take a lot longer? Do people need to be planning, hey, if I'm going to build, if I want to pull the trigger with my builder in December and be able to sign, do a down payment and get my draw schedule ready, do I need to be planning the historical 30 days out or 45 or 60 because everyone's working from home?
I mean, there is a definite shift in the industry. I've been at home for 11 years. So to me, I don't find that this is overly stressful for myself. Now, that being said, I was probably one of the few folks that I know in my industry that did 100% of their time at home. Today, that's different. It's the complete opposite way, but we're still firing on all cylinders. You have unprecedented rates. You have a mad dash for folks out of, urban areas, and that means buying residential existing property and buying new construction right now. So we're seeing, and again, with their industries allowing them to work from home, it's creating a further and a further from the geographical town center than they've ever seen. The setbacks, they're slower. They're slow. The industry's slow. The appraisers take a while, the title takes a while, the attorney takes a while, we take a while because as, let's say processors or underwriters are working from home, they may not have been set up with the proper bandwidth or maybe phone lines and things to operate. And will they be returning to work? We don't know. Maybe they will, maybe they won't, maybe it'll be at a reduced capacity. But the thing is, we're still moving, and then at unprecedented times that we haven't seen, and application volume that's extremely high. So there's, if you're applying, yes, you can still do 30-day closes. It's possible. Do you want to advertise that? Probably not, because, really that could be the extreme. You're more likely going to see a 45 or 60-day process. And in a convoluted, complicated loan like construction, you might be 45 to 60 to 90 if they don't have all their ducks in a row, like a builder selected, like a plan selected, like having the lot selected and maybe having permits in place if they need that. So there's definitely some drawback, but a simple purchase, that could run 26 days or 30 days, but it's a stressor because you're getting thrown into the mix with everybody still in a new process of working from home. So
So if I'm ready, if I've got my ducks relatively in a row, and I know what plan I'm going to build, and I know how much the house is going to cost me from the construction company, from the builder, it's realistic still, even with everyone working from home, that 45 days from me applying, I can pull the trigger, or even 60 days if I want to be a little careful. And then you're not going to pay anything if you're early and you don't want to take a deposit or a draw right away. It's not like you're going to lose anything by being early, right? So it's probably safer to play on the 60 or 50-day side of things than it is to try to hope for things to happen in 25 or 30 days.
I would say the sooner the better, because you can always close and not have to pay any money if you're not borrowing any money. You also secure a today rate versus a rate 3 months down the road, which we don't know what that's going to be like. So I'm always of the guys, the sooner you do it, the better. And construction's a different world, as you know, because these things, you're going to do a lot of upfront planning and, of the house, especially in the modular world, where once
Hmm.
that plan is sort of set, it's coming down the production line that way. Unlike site built, which you can make a change in the middle of this, it's very difficult to go change the site plan post you've done. That's why there's a lot of upfront work. But again, you can do a lot of things simultaneously, get pre-approved and sort of get your place in line. And then again, you pull the trigger when that plan is done. And then again, that 30-day closing, if it happens, great. But if it's 45, you're ahead of the game. You're still prepared mentally for it.
Yeah.
So I think the sooner things are looked at and placed in line. The only drawback today is documentation expires quicker. It used to be a 60-day expiration. It might be a 30-day expiration. And that means you might have the inconvenience of actually updating a pay stub and bank statements more than once, which is a pain in the neck, but it's a necessary evil in today's world. So.
Sure. So then, when does the clock start till they really need to close? And how long is that time frame?
I'm not sure what you mean.
So like I'm gonna borrow on a construction loan. How long do I have before I need to be, have the loan finalized? I've moved into my house. Do I have 12 months? Do I have 10 months?
Oh, yeah. I mean, technically, depending on the lender, you could be anywhere from 9 months to 18 months without having any kind of difficulty. In my world, I could technically go out that far. And again, like a smaller project, you would not expect it to go that long. A larger project, if it's more custom, you would. It's just there's more components, and sometimes the manufacturer might be delivering more of partially completed and then doing an on-site interior finish for different things. Again, it just depends on the part of the country and what's normal in that case. So
Sure. Yeah, but regardless, with modular construction, I mean, the likelihood that you run into an 18-month build time is pretty slim to none. So it
very
sounds
rare.
like this the wise thing to do is get started, aim for a 60-day pre-closed construction application and make sure all your ducks are in a row that way. That makes sense. Okay. So I don't want to keep you too much longer. I really appreciate your time here today. One of the other things you want to mention that I kind of wanted to ask, just just a national perspective, which you don't have a lot of people we get to talk to that has such a good one as you do. But you talked a little bit about people working from home. It's a more broad scale than it ever has been, obviously, with the pandemic. And then people having the ability to de-urbanize and maybe even turn their, historical like vacation type neighborhoods into full-time neighborhoods. I mean, you're seeing that trend. I know the NHB is pushing that direction at us. Hey, this is the first time in my lifetime that we've been talking about de-urbanization, but it sounds like from your perspective, you're seeing the same thing.
Yeah, we're seeing it a lot. And again, I don't want to say I cover, but my client relationships go Maine to South Carolina into Florida out to Missouri. I live out in Wyoming sometimes, so like in that case, I see it from not only personally even. So in the bigger cities like where we're in New York, we're seeing folks being able to not have to live in the city and maybe buy a primary home in the Hamptons, or they can be on the Jersey Shore, they could be up in the Catskills. You'll have people from New York living in Pennsylvania commuting right through New Jersey because maybe they only need to go, once a week or once a month into a commercial space in New York. I'm seeing, the Carolinas, Tennessee, a lot of inquiries. Some of my manufacturers down there, what they're having is, literally the people come in and just like they were unsure that they were going to do something. Now they're building a second home, that they can use as a primary in case another pandemic happens and they have to get out of the urban areas. Their intention is, well, if I can pull off working from home, heck, I can live anywhere. Like I ended up in Wyoming because I could live anywhere on the planet. I said to my wife, "Where do you want to live?" She said, "Wyoming." I said, "Fine." We moved. And then, my business, which is based, all say phone, internet, things like this. I'm not the only person around that can do this kind of stuff, but it does give me the freedom to raise my kids differently and things of that nature. So it's definitely a de-urbanization of all sorts. And again, the second home market is screaming busy. I mean, you have other things like Airbnb. So where they build these homes, they're looking at renting them out when they're not there if they do have to go back to an office space for a little while. So there's definitely a really big switch. The market that I sit in, which is technically the Poconos of Pennsylvania, it is very eerily like it was after 9/11, where we had this huge influx. Where, say, last year at this time we had 5,000 homes on the market. Today there might be 800. So
Wow.
it's crazy. Yeah, I mean, and which is good. I mean, it's good because this is going to be. I think the commercial real estate is going to be a different market or a different world, because again, our company may have, a site that has 3,000 people that they've only had 200 people in at any given time over the course of the last 3 months. Why would someone necessarily need to keep a commercial space? Is my
Yeah.
opinion for any company like that. So now what happens to those commercial spaces? Do they become condo conversions or something in that area? Who knows? I mean, this is
Yeah.
very interesting times. I think there'll be books written for decades about the last 6 months of this whole thing on everything. So
Yeah. Yeah. Well, I mean, to pile on to what you're saying about the deurbanization a little bit, we're just seeing a massive amount of people inquiring about building homes that's not their primary location. So to them, modular makes perfect sense because they're not going to be on site. They don't know the area. They don't know a builder in the area. And frankly, I mean, what I've seen for the past 10, probably, 20 years is a little bit before my time, but I know what was going on then too, is we've seen less and less builders in non-urban areas because there's been less and less new building, less and less people. So we're on board with the reversal of that trend. It's interesting to hear that you are too. And I agree totally. We're in an unprecedented time. And, you answered a question earlier about, what the rate environment looks like for the rest of the year with, geez, let's see where this pandemic goes and let's see where the election year goes. So it's going to be an interesting rest of the year. I'll tell you that much.
oh yeah, there's no doubt. It's been a wild ride. The first 6 months. I mean, we're just holding on. I mean, it's been fun. I don't have a boring day. Let's just say that.
Yeah, that's I could reiterate that. There's a few fires to put out every day at least. So, all right. Well, Tom, I really appreciate your time. This has been really helpful to me and hopefully to our listeners too. I want to give you a second to just tell people, who are listening, if they want to get a hold of you about a potential mortgage application or questions, can they do that somehow?
Sure. I mean, easiest way is text me on my cell 973-229-7698. Call me as the cell. I have a less likely chance on picking up because of the volume that we see. Or you can email me at tom.coronato@citizensbank.com, and it's tom.coronato@citizensbank.com.
Awesome. Thanks again, Tom. And we'll have Zach post that stuff when he does the podcast as well. So we'll have that information readily available. To everyone who's listening here today, I hope you found this information as helpful as I know I found it. You can find On the House podcast anywhere that podcast can be found, Spreaker, iTunes, Android environment. And as always, I'm Alex. I've been hosting on behalf of Rochester Homes, and thanks for listening.